In today's episode, I will talk about three very interesting stories. In the first story, I'll talk about India's new approach to FDI or foreign direct investments. In the second story, I'll talk about energy transition and how a lot of money is flowing into clean energy right now. And in the third story of the day, I'll talk about a new report from the World Bank which talks about India's growth story. Welcome to the Daily Brief show by Zerodha, where our aim is to give you financial news in a way that is one level deeper as compared to traditional news channels. I'm your host Anurag Bansal, and today is Friday, the 11th of October. Recently, India decided to take a very cautious and targeted approach to adjusting its FDI or foreign direct investment policy. The government has chosen not to implement a major change or overhaul for now. Instead, they're focusing on smaller sector-specific tweaks in areas like defense, insurance, and banking. Now, the idea behind a full overhaul would have been to rework the rules that allow foreign companies to invest in our country. But the current strategy is to focus on gradual improvements where they matter the most. By the way, over here, in case you're wondering what exactly FDI is, let me take a short pause and explain what it means. See, very simply put, FDI is when foreign businesses put money into Indian companies, bringing in capital that can boost industries, create jobs, and help the economy grow overall. India has been opening up more sectors to foreign investments over the years, but now it seems that more targeted changes are the way forward. Interestingly, at the start of 2024, the economic survey suggested that India should consider allowing more Chinese FDI. Now, the argument here was that Chinese investments, particularly in electronics manufacturing, could help India increase its exports. Now, this suggestion fits into the global China plus one strategy, which we've spoken about multiple times, where companies are looking to diversify manufacturing away from China by setting up in other countries like India. Now, the idea was that Chinese FDI could lead more factories and job creation in India rather than India continuing to import Chinese products with minimal local value added. However, India's Commerce Minister Piyush Goyal quickly shut this down. He made it very clear that while the economic survey provides ideas, they aren't quite binding and the government is not rethinking its position on Chinese investments. Now, this stance reflects India's broader caution when it comes to foreign influence, especially in strategic sectors. China's role in global manufacturing is very significant, but for India, this relationship has been very sensitive, particularly after the 2020 clashes in the Galwan Valley. Now, a good example for this cautious approach is the case of BYD, which is a Chinese EV giant. BYD wanted to invest $1 billion in building a manufacturing plant in India, but the government rejected the proposal. Now, instead of building cars locally, BYD is focusing on importing them into India, which is a more expensive option. For a country aiming to become a global leader in EVs, this could have been a major opportunity, but national security concerns took priority over potential economic benefits. Now, India's reluctance to open the door wider to Chinese investments is very clear, especially in sensitive areas like AVs as I mentioned earlier. In addition to sector-specific changes, India is now also considering setting up a foreign investment regulatory mechanism to monitor FDI a little more closely. This would act as a watchdog, keeping track of foreign investments after they have been made to ensure that the money coming in aligns with India's broader goals. The aim is to make sure that foreign investment supports the country's interests without introducing unwanted risks. This layer of supervision would help make FDI safer and more beneficial in the long run. So while India will continue to welcome foreign investments, it is very clear that the government is taking a very measured approach. They are encouraging investment where it makes sense, while they're also very careful about which countries to get to invest, especially in sectors that could have national security impacts. Now, moving on to the next story, let's talk about energy transition. I'm sure lately you've noticed a lot of talk happening around energy transition, and that of course is for a good reason. In FY 2024, global investments in clean energy reached a massive $2 trillion. Now that is a 60% increase since FY 2020, and now more than double the investment is being made into fossil fuels. Now you might think it makes sense, right? Everyone is pushing for a greener, cleaner world. And of course, India is not sitting out on it either. Just last year, we invested $82 billion into clean energy projects, all a part of the goal to generate 50% of our power from renewable sources by the year 2030. But the question is, with all this money flowing into clean energy, does it mean that traditional oil and gas are falling behind now? You might think fossil fuels would be on their way out, especially with the sunset industry label that they often get nowadays. The theory of peak oil, which suggests oil production will hit a high and then start to decline as reserves run out, seems to support that idea. So the question is oil as good as dead? Well, not quite. The reality is a little bit more complex than this. While it is definitely true that clean energy investments have surged in the recent past, fossil fuel investments has not exactly stopped either. Since 2020, investments in fossil fuels has grown as well. They have risen from 900 billion US dollars to 1.1 trillion US dollars. Now, of course, this is not increasing at the same pace as clean energy, but it is still a very significant number. Also, interestingly, most of this push for more fossil fuel investment is coming from companies in the Middle East and Asia. So, what does this mean? See, there is no doubt whatsoever that clean energy is moving ahead, but the global picture is still very mixed. Emerging markets and developing economies, or EMDEs, excluding China, only account for 15% of global clean energy investment. Instead, these countries are putting more focus on fossil fuels and trying to follow the same path that developed countries and China were on until a few years ago. In this story today, I wanted to take a closer look at one of the key players in the EMDE group, which is India. But before understanding what India is exactly doing in this space, let's take a step back and understand the bigger picture of fossil fuels here. See, fossil fuels, as you probably already know, come from sedimentary rocks. They're formed over millions and millions of years from decayed plants and animals that are buried under layers of sediment. With enough heat and pressure, that organic matter transforms it to coal, oil, or natural gas. India has 26 sedimentary basins, which spans an area of 3.4 million square kilometers. Now, these basins are split into three different categories depending on how mature these resources are. Under the Open Acreage License Policy, or OALP, these basins are further divided into smaller blocks which oil and gas companies can bid on. By winning a bid, a company gets the right to explore and extract oil or gas from that very region. Now, here is where things get interesting though. Only about 10% of India's sedimentary basin area is currently being explored. The rest is either locked away as no-go zones or it is considered not profitable enough to even attract investments. And that is a pretty big deal when you consider there is an estimated 22 billion barrels of undiscovered potential in India's lesser explored basins. To put that into perspective for you, India has only discovered about 2 billion barrels of oil in the last 2 decades, while countries like Angola, Norway, and Guyana have each found 10 billion, and Brazil has found an incredible 40 billion. But now, India's Petroleum Minister Hardeep Singh Puri wants to change that. He made it very clear that we're sitting on untapped resources and he is now pushing to open them up. Recently, the government has cleared 1 million square kilometers of previously off-limits land for exploration, and the response has been very positive. In the latest OALP round, 38% of the bids were for these newly opened areas. But it's not even about just more land. The government is also encouraging foreign companies to get involved in India's exploration efforts, offering incentives like compensation for helping with seismic surveys. They are also reforming the legal framework to protect companies from unexpected taxes and are making it easier to resolve disputes outside of India. All of this points out to one clear goal: reducing India's reliance on oil imports, which cost the country over 150 billion US dollar every single year in foreign exchange currency. But the question is, will this strategy really pay off, especially considering the rest of the world is very fast shifting towards renewable energy? That is the big question India faces right now. In the next story, let's talk about the latest economic update from the World Bank, which comes with a couple of big takeaways for South Asia, particularly India. Now, there's a lot to look at here for you and me as investors. There are upgraded growth forecasts and also the ongoing impact of climate change on this very region. We'll also look at how shifting global dynamics are creating both challenges and opportunities for South Asia's economic stability. Now, there are three parts to the story, and this is slightly long, so do bear with me. The first part is the World Bank's upgraded growth forecast for India. I'll talk about what is driving this and what it really means for the country's outlook. The second part is discussing how extreme weather is hitting South Asia, especially India, and the possible economic and social fallout. And the third part is discussing the implication of geopolitical shifts and how South Asia is navigating this increasingly fragmented global economy. So let me first start with the good news for India's growth prospects. See, the World Bank has revised India's growth outlook upwards. Growth for FY 24-25 has been bumped up to 7% from a previous estimate of 6.6%. And while it is expected to dip slightly to 6.7% in FY 25-26, India remains one of the fastest growing economies in the world right now. South Asia as a whole is set to perform well, but it's India's strong domestic demand that is really setting up the pace here. So the question is, what is really behind this updated forecast? First, stronger private consumption. See, private consumption is one of the key drivers here. A better than expected agricultural rebound, along with policies that are aimed at boosting employment, has helped push spending higher. Rural incomes in particular are benefiting from stronger agricultural output, which is creating a positive ripple effect across the economy. Second is the agricultural boost. See, after a solid year of productivity, agriculture has outperformed forecasts, which is giving a significant lift to income levels, especially in India's rural areas. Better than expected harvests have meant more spending power, which in turn has supported broader economic activity. Third is manufacturing and services. The Purchasing Managers Index or PMI shows India's manufacturing sector is expanding at a pace above most emerging economies. Meanwhile, the services sector, which has been in growth mode for about 30 months now, continues to be a key driver. Now, while the growth in goods exports has been a bit sluggish, services exports, especially in IT and finance, are more resilient and helping to maintain momentum. The next is rising portfolio investments. See, foreign portfolio investments or FPI have surged and are nearly returning to pre-pandemic levels now. They have been on an upward trend for 8 consecutive quarters, unlike many other South Asian countries where such inflows have stagnated now. A key factor here is India's recent inclusion of rupee-denominated government bonds in global bond indices, which has boosted investor confidence. By the way, a quick note on FPIs. See, FPIs, unlike long-term foreign direct investments or FDI, are typically shorter-term investments in financial assets like stocks and bonds, and they can be more volatile. But this inflow of capital shows strong confidence in India's markets. The next is stable inflation. See, India has kept things under control over here. With inflation well within the RBI's target range of 2 to 6%, consumer confidence is getting a boost. Lower inflation encourages more spending, which further supports economic growth. Now, that is the first part of the story. Let's now move on to the second part of the story and talk about something that is a little more concerning, which is climate change. See, South Asia and India in particular is increasingly feeling the effects of extreme weather events. Heat waves and floods are becoming more frequent, and their impact is both humanitarian and economic in nature. Intense heat waves are becoming more and more common, especially in India where it is hitting the poorest households the hardest. Many lack access to cooling systems, which makes them particularly vulnerable to this. The result is lower productivity and a higher risk to their overall well-being. But it is not just households that are feeling the heat here. Small businesses are also taking a big hit. Many do not have financial capacity to adapt to rising temperatures or flood risks, which makes them less productive. In industries like garment manufacturing, which heavily rely on labor-intensive processes, the impact is even more pronounced. Now, all of this highlights a growing inequality in how climate change affects different areas of society. Poorer households and similar firms bear the brunt, while larger businesses often have the means to adapt. There is an urgent need for targeted measures such as better social protection and more resilient infrastructure to help the most exposed to climate change. If these issues are not addressed, they could seriously derail economic progress of the country. Now, finally, let's talk about the third part, which is how South Asia is handling the shift dynamics of the global economy. See, as the world becomes increasingly divided into economic blocs, countries are having to adapt newer challenges. And for South Asia, that means both risks as well as opportunity. See, historically speaking, South Asia has not quite been as tightly integrated into global trade networks as regions like East Asia. While this means it is less vulnerable to global trade disruptions, it also means that the region has missed out on some of the benefits of deeper integration into global value chains. India, for instance, has been increasing its reliance on exports and FDI from countries like the US and the UK. This has been great for economic growth, but it comes with some risks, particularly when tensions between these countries and others like China rise. Interestingly, China is a smaller player when it comes to FDI in India as compared to other emerging markets, and this somewhat shields India from broader geopolitical shifts. Also, India is not sitting idle here. The government has introduced the National Logistics Policy, which is aimed at improving infrastructure, cutting logistics costs, and making exports more competitive globally. The goal here is to ensure that India can benefit from global supply chains while remaining protected from the risks of economic fragmentation. On the services side, India continues to outperform. Even as global goods trade faces challenges, India's IT and financial services sector are thriving quite a bit. This gives the economy a buffer against some of the uncertainty around global trade. But that said, despite all these strengths, FDI into South Asia still has not quite recovered to pre-pandemic levels. There is great amount of work to be done in improving infrastructure, cutting bureaucratic red tape, and creating a more predictable business environment in order to attract global capital. So in short, while global fragmentation does present challenges, it also opens up many opportunities. By strengthening its manufacturing base, expanding trade partnerships, and improving the ease of doing business, India and the broader South Asian region can turn those headwinds into long-term growth prospects. So while there is a lot to keep an eye on here, the key takeaway is that with the right strategies, South Asia, especially India, has a very good chance of navigating these global shifts successfully. Moving on to the next section, let's talk about the tidbits. First, the Reserve Bank of India has issued a word of caution to NBFCs or non-banking financial companies. They have stressed on the importance of prioritizing responsible lending practices over rapid expansion. The concern here is that aggressive lending, particularly with high interest loans, could pose a risk to overall financial stability and lead to the return of credit risks that regulators have been trying to keep a check on. Second, India is on track to meet its entire mobile phone demand through domestic production by the end of this fiscal year. This is a significant shift as it will reduce the need for imports while also strengthening India's position as a global electronics manufacturing hub. Companies like Apple and Samsung with their local production units have been very important players in driving this very growth. Third, Infosys and Microsoft have expanded their partnership. The focus this time is on integrated generative AI into Infosys' solutions. The aim is to improve cloud services and increase productivity for their global clientele, building on the strengths of both companies in tech innovation. And lastly, fourth, Vedanta has made a significant move to reduce its debt load. The company has made an early repayment of 869 million US dollars in bonds. By cutting down high interest debt, Vedanta is aiming to improve its liquidity management, which should help with overall financial stability. Now, before we end this episode today, here is a small little tribute from Team Daily Brief towards Mr. Ratan Tata. Mr. Ratan Tata's passing away on the 9th of October 2024 feels like the end of an era. Mr. Tata was not just an ordinary business leader, but he was a symbol of integrity, quiet strength, and genuine compassion. Even though most of us have never even met him, this loss somehow feels very personal. But as we mourn his loss today, we must also celebrate his legacy. It is one that is very rare and very difficult to match. Ratan Tata led the Tata Group as chairman from 1991 to 2012. Under his guidance and leadership, the Tata Group expanded globally. They made high-profile acquisitions such as Jaguar Land Rover and Chorus Steel. Mr. Tata also oversaw the launch of the very popular Tata Nano, which was a car designed for the masses of India to realize their four-wheeler dream. Additionally, under his leadership, TCS became one of the largest IT services company in the world, and TCS has been a very significant contributor to India's technological rise. In fact, TCS alone employs over 6 lakh people today. But Mr. Ratan Tata's ambitions were not solely about business or profit. His work with Tata Trust shows his belief that true success is measured by the positive impact left on society. Mr. Tata uplifted countless lives through his philanthropy initiatives. When we think of powerful figures, we usually focus on influence or wealth. But Ratan Tata's legacy was very different. It's not just about the companies he built, it is also about the quiet, meaningful ways in which he touched lives. Like I said, even though most of us have never met him, this loss feels very close to home. Rest in peace, Mr. Ratan Tata, and thank you for teaching us the true meaning of greatness and leadership. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.